Pramod Gubbi is co-founder of Marcellus Investment Managers. Pramod, great to have you with us here. Thank you very much for your time. It's always a pleasure. Pramod, I know you kind of look at longer-term sort of structural things when you look at your portfolio, the company that you own in the portfolio. But all of this, of course, is happening in, and the outperformance here that we are seeing in India is happening amidst a world which is kind of slowing, right? So far, we've managed to kind of ignore all of that in a very outsized way. Markets, for example, of course, the Nifty, the stock markets show that in the most pronounced way. The rupee is another one which shows that the stability in a very, very pronounced way. Any thoughts on whether if the world slows down meaningfully, it'll show up meaningfully here in India, or you think we can continue like this?
Thanks, Prashant. Thanks for having me. Always a pleasure. Look, the reason we focus on long term is for exactly these sort of reasons. Many of these developments are not particularly within our purview of forecasting or predicting. Because sheer number of factors involved here makes it that much more difficult. Even the best of economists struggle to do that. Having said that, I think whether a broader slowdown in the world will affect India, of course it will. We are living in a globalized world, increasingly so. So we will certainly get affected, particularly, say, export-oriented sectors will face that demand. If interest rates go up, capital flows and cost of capital will also take a hit. But having said that, amongst all other emerging markets, relatively speaking, I think we do stand out because, fortunately or unfortunately, we don't have a thriving export sector compared to some of our other emerging market peers. We're largely a domestic market-driven market. And the events over the last 10 years or so has also meant that from a capital reliability perspective, we've also become self-reliant, right? The financialization of savings scheme that we've been talking over for the past decade or so, the move away from real estate and gold for Indian households has meant that across financial assets, whether it's bank deposits, mutual funds, equity markets, you're seeing the numbers across the board. We've seen household savings being channelized into financial markets, which in turn has brought down cost of capital. I think the numbers are quite incredible, right? We're still looking at home loans at par or in the vicinity of the 10-year G-Sec yield, whereas in the US, home loans are at almost 300 basis higher than the US 10-year G-Sec yield. So this structural correction of cost of capital is a big boost for the Indian economy, which makes us less reliant on the external world. So relatively speaking, I think we should be all right, irrespective of what will happen. There will be ways in which we will get affected, but I think we have made enough changes as far as reforms are concerned, as far as infrastructure is concerned, as far as our financial markets are concerned, to chart our own course for the next decade or so.
Okay, fair point. Yes, Pramod, good morning. That's always been the strategy at Marcellus, right? You've been bottom-up stock investors and really haven't bothered about which way global markets or index is headed. So what new themes have you identified? Have you added any new stocks that you are at liberty to discuss, in terms of your bullishness, if you could tell our viewers?
Well, our changes are very infrequent, right? Because of the sort of long-term nature of investing that we do, we tend to have very long holding periods and very little churn in our portfolios. So I'm not sure when we spoke last, but at least for the reasonably recent past, we haven't really made any changes in the portfolio. The themes remain the same. We've always been positive on domestic consumption. We've been positive on home building materials. It's our way of playing real estate, which is a structural story in India. We've been positive on financials for a fair period, and it's taken off finally, largely because of the financialization of savings scheme that I talked about, but also we reckon if there is a cyclical uptick in the Indian economy, which we do believe we're in for at least a 3 to 5 year run, then financials should benefit. And if you factor in, inflation and rising interest rates, then again, financials will be a beneficiary. The big theme, I would say, is if inflation were to stay entrenched for a while, investors need to be looking at businesses which have extremely high pricing power. Otherwise, inflation will drive down earnings. Companies with pricing power will be able to pass on their input cost increases to their customers and keep their margins and returns on capital at really sensible rates. And more importantly, they'll come out stronger from this period of high inflation as high inflation hits some of their competitors pretty badly. Rising rates will hit some of their competitors pretty badly. So focus on high quality businesses, quality defined as strong balance sheets, clean governance, and high pricing power. You'll emerge out of any adverse situation from a macro perspective pretty stronger. And that's what's been our investment philosophy. Focus on protecting the downside. You'll eventually make money for investors.
So what is the big theme that you're looking at from an investor standpoint for the rest of the year, or at least for the next 18 to 24 months?
So I think financials, like I said, is a big theme, given that it plays into rising inflation and as a result, rising interest rates. And if we do believe that we are due for a capex cycle in the country, credit growth should also pick up. We're already seeing numbers that we haven't seen for a long time, 14% non-food credit growth in the banking system. I'm not sure how many of us remember seeing that sort of number. So we're clearly seeing a benefit both in terms of loan growth as well as margin expansion for banks and better funded NBFCs. I wouldn't say all the NBFCs, some of the NBFCs with very little strength on the liability side will suffer in a rising rate environment, but some of the better funded NBFCs should also benefit from that. So banks and NBFCs should definitely be a theme if this sort of recovery that we're seeing in the underlying economy stays put.
We just keep an eye on the market, because after the initial profit taking that always happens, the first 5 minutes you wait for it. Now the market's making a move, and keep an eye especially on the bank Nifty. It underperformed yesterday. It's taking out recent high 39,837, and the kind of shorts that we have in the system today could be the day when shorts perhaps are taken to cleaners, because the market absorbed the initial profit taking and just moved on. Yesterday, of course, the market did not fall, and now the market's got a big tailwind with it. Pramod, GMM Pfaudler is in news. That's one of the large investments that you have, but it's nowhere near its highs. At Marcellus, are you still keeping the faith in this story?
Yeah, absolutely. I mean, we do own it across all our portfolios, and we are all, as you know, all our employees are investors in Marcellus portfolio. So both us and our clients own GMM Pfaudler, and we continue to have very high confidence in the story. We're not so perturbed by short-term stock price movements as much as we would look at the fundamentals, and the fundamentals continue to be reported very strongly. It was a big bet that they made in terms of acquiring the parent company, Pfaudler, which did come with its own integration risk, but we're glad to see that 2 years hence, that integration has panned out really well, which is reflected in pretty strong order books, both locally as well as globally, and also benefits on the cost side in terms of shifting production to lower cost supply side geographies than it was with Erto. And more importantly, I think the structural transformation of GMM Pfaudler from being just a single line of products in terms of glass line vessels to providing a more solution-oriented approach towards chemical and pharmaceutical industries, which means that they'll keep adding new products to pump into the same pipeline going through to their existing customers in chemical and pharmaceutical industries, which means that the addressable market continues to expand, and therefore the growth runway remains pretty strong. It's always been an execution challenge, but the way the management has executed over the last couple of years gives us an immense amount of confidence in the long-term story.
Okay. What about, some of the other spaces that are doing quite well? I mean, we spoke about autos, the consumption theme. Auto ancillaries have done very well. A lot of the global-facing auto stocks are getting hit because of lower exports, hitting markets like Africa, etc. But domestic growth is looking very strong. In that entire universe, what is it that you still like?
Well, autos are bound for a recovery for some time now. We've had a couple of supply side challenges. We anyways entered COVID with a weak background as far as demand was concerned, and COVID put a further challenge on the supply side. Even now, I don't think the entire semiconductor shortage issue is gone, but at least it has abated somewhat. So to that extent, that latent demand that had been postponed is driving top line growth there. Some correction on the raw material front has also helped margins come back somewhat. So we should see a decent cycle, at least for the next 2 to 3 years, as far as demand for autos is concerned. Within that, I think if you believe that there's an underlying economic recovery which will drive industrial recovery, commercial vehicles should definitely do well on that front. But so will passenger cars and two-wheelers. But amongst the three, I would say commercial vehicles are best positioned within autos.
You do have exposure to some chemical stocks as well, right, Pramod? If my memory is right. Do you still have them, and what's your view here?
Yeah, so we do own companies like Alkyl Amines, Fine Organics. Both are stocks that we own across all our portfolios for our clients as well as ourselves. Here, of course, the story is both top down and bottom up. The top down is something that we've been talking for a long time, where buyers in the West have been looking for an alternative supply source beyond China. China has dominated the specialty chemical space for a long period of time, and continues to do so. Mind you, it's still almost 10 times larger than India in terms of the production capacity size. But some of that is shifting towards India. So that's the structural top-down tailwind for that sector. But within that, I think we continue to work bottom-up in terms of identifying companies and businesses which have immense amount of pricing power, which will protect them in high inflationary periods. Because remember, we're still dependent on some inputs coming from China as well. And given geopolitical issues there, you will need companies which can protect themselves against those sort of issues. So the top-down macro is very favorable, continues to be so. But within that, you have to be careful in terms of picking companies which have structural competitive advantages, either in terms of the strength in chemistry or access to raw material, and have a very successful capital allocation track record. Because it's very easy to get carried away in times like this and start an unbridled expansion spree. We would like companies to expand into areas where they can extend their competitive advantages into adjacencies, and then continue to drive future earnings and cash flow growth.
Are you talking about Balaji, Pramod? Balaji, I mean, that one is expanding. Large capacity expansion program. Yeah, sorry, go on.
Yeah, so we own Alkyl, which is pretty much in the same space. I think between Alkyl and Balaji, they have gained share from the other PSU companies, pretty much an oligopoly there. They continue to generate pretty high returns on capital. So far, our preference has been Alkyl. We've owned Alkyl for the better part of the last 3-4 years, and we don't see any reason in changing a preference there.